Hi guys, I hope you had an awesome weekend. It's Monday, so here we are again, and this is week 9, right? Advising week, and for PED318, we're going to be covering chapter 10. I want to talk about a couple of things before I move on to what we usually cover every week. I did submit your midterm grades. And I want you to understand that midterm grades are just indication of your performance so far. So you should use them in a way to know where you stand and make the necessary adjustments. I want to point out that the letter grade that you got does not include any extra credit you may have already received. So that will be additionally added at the very end. I will also offer a few more opportunities for extra credit for the ones who are interested in that. So midterm grades, use them wisely, use them in a way that help you make the necessary adjustments for the second half of the semester. That's one thing I wanted to say concerning advising. If you are one of my advisees, I have already shared the document. It's a Google Doc. So make sure you go there and you find the time slot that works best for you. We have 2 days this week and 2 days next week. Okay. You have 15 minutes. Please come prepared. You should know your plan. And I will just advise at the end of the day, it is your call what path you would like to take. Just make sure at the end of the advisement, I don't forget to give you your PIN number that you'll need in order to register for spring and winter 2021. Okay, so midterm grades and advising. Also about advising, because there's advising this week, I'm gonna include advising in my office hours, and also I'm not gonna offer that synchronous meeting that I offer every 3 weeks. So I'm gonna move that. I'm gonna postpone it and move it to week 10 because a lot of you, I'm sure you have advising, so I don't wanna put that synchronous meeting during a time that you cannot attend. So I'm gonna move this third synchronous meeting to next week. But of course, I'm gonna talk about that again next Monday in our video. All right. So those were the extra announcements. For what we usually do, I'm going to share my screen. I'm going to go to our Moodle side, and here you'll see that we had LO9, okay, and 2 LPs as usually, and 2 PDOs. The groups have already received individualized feedback about the LPs and the PDOs. If you have any questions about anything and you have to submit next week, please let me know, okay? Let's visit, and I will try to facilitate as much as possible. Now, about LO9, the mean score, the average score is 80%. Again, a lot of people are trying to rush it and submit it last minute. And sometimes, unfortunately, you pay the price of missing 1 or 2 items. There are only 5 items, okay? All the answers are in the slideshow and or the videos. So if you can watch the video first and at the same time have the slideshow next to you, try to understand, then I think it won't be that challenging to get a 100 that low, especially if you think that there's no time limit. So you can just watch the video again, and again until you figure it out. Just a friendly suggestion. So that's about what we submitted this week. Next week now, so my video is going to be about financial management, and we'll have LO10 until Sunday, 2 LPs and 2 PDOs. Okay, so we're getting there. We don't have a lot of chapters left, and the TAs are going to cover a couple of them as we move on. Keep keep killing it. Keep trying as much as possible. Ask me questions. Engage as much as you can, and we'll totally be fine. All right. So I'm going to stop sharing the our middle side, and I'm going to share, uh, as you may have already predicted, our PowerPoint slideshow. So today we're talking about financial management, and this will introduce you to this kind of specific function in sport organizations. As you see in this initial slide, a number of core accounting principles will be discussed, not in a lot of depth. I don't want you to freak out, but we'll pay some special attention. We'll give some special attention, as you see here, right, to budgeting process, uh, analysis of balance sheets. That's very important. Profit and loss statements, and also the cash flow statement. And in general, we're going to talk about some principles that have to do with uh, what we would call sound financial management, right? So in general, I'm going to try to introduce you. You haven't been introduced to several accounting terms and financial management concepts. That's why I said from the very beginning, I don't want you to freak out. However, I want you to understand that the overall aim today or for this week is for you to build a broad understanding uh, and a broad understanding of the accounting vocabulary. So we're going for a basic level of financial literacy. So financial literacy is the key term for today, which will help you do what? Which in turn you can use to be better in understanding, administrative processes required to build a sport organization's financial viability. So accounting and financial literacy in order to build the organization's financial viability. That's the basic, the key aim for this week. Okay, I want you to. I'm going to go slowly, and I'm going to try to explain things as much as possible. So, in like other forms of business, sports organization require a strong system of financial management to be successful and in general to be sustainable in the long run. Uh, that's something that we do know now and that we preach now, but that hasn't been the case all the time. So slowly, the sport organizations moved into that approximately the last 50 years. But this metamorphosis had to go through some stages or phases. And these are the phases that we're going to talk about today: recreational and cultural practice, commercialization, bureaucratization, and corporatization. And in order to understand that a little bit better, we'll use this table. So in this table, as you will see, uh, the I'll move this right here. So everything starts from phase one, right? Here, the revenue streams are small, as you understand, and sport is played mainly for fun. You see, we have a lot of amateurs and a lot of volunteers, especially like officials. Yeah, and this is described as the kitchen table stage because usually, all the important decisions are being taken by very few men and usually happens around the kitchen table of somebody's house. Okay, so things are not that formal. It's stage one after all. Of course, it has some strengths and some weaknesses, and here we have involvement of grassroots players, which is, of course, something very um, positive. And concerning the local community, it really supports it. But it is, of course, you can have a lot of revenue, and you can attract a lot of resources to grow. So you just stage one is where you started, and then you move to stage two, right? So in stage two, what happens is called, first of all, commercialization, and some things remain the same, but you can see that the revenue focus now moves from those member fans. So here, there are a lot of similarities, but one main difference is that instead of member fees and social club income revenue, we have different sources of revenue. Okay, and this is great because now by doing that we can attract other sponsors as well. As we move to the third phase, bureaucratization, things are getting a little bit more formal. The structures become more complex. Administrative controls are more kind of formalized, established, and the functional specialization increases. Now here, we don't have just some people, right? Usually we have a board of directors who have a lot of responsibilities, including having a strategic plan, having a specific direction that everybody should aim for. And sometimes here we have it's where we have some kind of involvement from the government. And then stage four, it's the last stage, and this is the final phase. It's called corporatization. Here we have more of a business model, and here we value brand management. Of course, we have more revenue streams and from different sources. For example, the broadcast rights and all these brand sales are deepened. Okay. Now, this phase is more like a shift towards what we call managerialism. Okay. And this, because it's more formalized, it has more transparency. So there are a lot of reports that show, what comes in, what comes out, which is always good. Of course, it makes the operation a little bit more complex, and sometimes what's the right word? Less less it's harder for the corporation to adjust and move quickly. That's what I was trying to say. There's a lot of government framed legislation, of course, and that's one of the reasons, and a lot of regulations. So we have regulations that come from the external environment, such as government, but also a lot of regulations that come internally, which is from the corporation itself. All right. So let's see a little bit where these those the sport organizations get some funding. So we talked about this new business model, and we love to teach it through these courses. But at the end of the day, uh, most operations are not in the sport organization are not that big. We know big, NFL franchise that flashy and everything, but most um, sport organizations are small. Okay, so uh, for any kind of organization we're going to talk about today, yes, there are all this sometimes, but again, member fees are still important. Fundraising from social activities are important. Gate uh, income or receipts are important, and for some of them, but not for all of them, we'll see that There is capital funding and recurrent funding as well. We're going to talk about expenses too. All right, so what is capital funding? And again, do not freak out. Just going to break it down in very simple terms. That's money, of course, and that's money that can be used to finance investments in assets. All right, that can come from government, and by saying government, we talked about the levels of the government before, right? Federal, state, local, any kind of level of the government. Uh, and sometimes, in order to get funding from the government, you need to comply to some specific rules or conditions. So if those conditions are met, then you can get some specific funding. Loans and borrowings, of course, that's important, and that can be short term, up to a year, can be long term, up to like 20 years, and this is also called as debt finance. Okay, new share offering. So here we offer ultimately a piece of a company, and it's called equity finance. And in return, of course, we get that value for the shares that we offer or we sell. Um, of course, we don't have that interest to pay or repay that we have with the bank with loan right here. But as I just said, in this case, we offer a piece of our company. Also, shareholders expect dividends, right? And then retained earnings is money that is reinvested in sport organizations, and of course that's great. And I hope you remember that when we talked about non-profit sport organizations, this is mandatory, right? Non-profit sport organizations, I'm just going to say it once again, is not that they don't have profits. Everybody loves profits. It is just that they take those profits and do what with it? They reinvest it. Okay, so non-profit or profit, some or all of it has to be retained earnings. Okay, so what is recurrent funding now? So capital funding, we said it's funding, it's just money to finance investment in assets. Okay, and then we have recurrent funding, which is what? Money to fund day by day operations. And that may come from a variety of sources, depending on the organization. It could be fees from the members. It can be whatever we charge the spectators, right? It can be lotteries. It can be merchandising. It can be sponsorships. It can be catering. It can be broadcast rights. It can be what else? Through dividends, and it can also be some kind of government grant. So there are many that can be grouped in the recurrent funding source. Now, expenses, again, a lot of variety, really high variety. We have wages, salaries, as you understand, staff on costs, we have office maintenance, or we have venue maintenance, we have player management, we have asset depreciation, and I'm going to talk about depreciation in a little bit because that's kind of an important term that I want you to understand. I want it to be clear after you watch this video. All right, a lot of questions, right? As I said before, the majority of sport is really in the form of small businesses, the majority. However, whether big or small, it doesn't really depend on size. There are some questions that we need to ask as managers. Okay, so we need to understand, we need to have that information, and that will really help us with financial management. I'm not going to go all over you see what do we own, did we make profit, are we borrowing too much, did we improve upon last year? But the thing is, those financial questions as sport managers, you need to have the answers. Okay. Now, when you have the answers, you you need to do what? You need to be able to understand it. So how are we going to make sense of all that vocabulary of accounting, right? Um, First and foremost, we have to understand the difference between assets and liabilities. And I'm pretty sure you've heard of those two terms in other contexts, like are you going to be an asset or are you going to be a liability, right? Um, I hope at least you understand that being an asset is positive and being liability is considered something negative. So asset is what? Is something that we own, right? And liability is something that we owe. Okay, as simple as that. Now, when we talk about we're going to talk about some very basic reports today. Okay, and the first one is the balance sheet, which does what? It measures the wealth of the sport organization at a specific point of time. So usually, as you see, the assets are going to be on the left side, right? And then the liability will be on the right side. And if we put them together, then we have a clear picture, if we contrast them, about what's going on concerning what do we own and what do we owe in our organization, as I said before, at a specific point of time. All right. Not all assets are the same. They can be broken down. Not all liabilities are the same. They can be broken down. I will use this table. I'm going to come back to help you understand that what's going on with assets, for example. You see on the left side, we have the category. And then something that it is important for me and I want you to understand is the degree of liquidity. And then, of course, the third one is an example. Now, you see the categories. Pretty straightforward. Inventory, office equipment, motor vehicles, property. Okay, cool. All the way up, cash in bank. Okay, cool. All right. What is liquidity? Liquidity is the degree of something that can be actually used or be transformed into cash. Okay, and that's really, really important. Of course, cash has a high degree of liquidity. Makes sense. And then, as you can see, for example, property has a low degree of liquidity. So we may own a property that costs or the worth is $5 million, but we don't have $5 million. We don't have the cash. And as managers tomorrow, there's always a question: what percentage do we keep in cash? What percentage do we invest? For example, right? So do we need to have a high degree of liquidity as a company or a low degree of liquidity? Because if you have too much cash, of course, you can react if something happens, a good opportunity or an accident, something happens, you have the cash to react. But if you keep too much cash and nothing happens or you don't use it, then you lose because you didn't really invest it in anything. Make sense? Again, I'm just trying to break it down just to make sense. I want you to be able to read it, if possible, some financial reports. Okay? Financial literacy is the goal today. Also, we have the fixed or non-current. And the fixed or non-current have to do again with the degree of liquidity. Something that's non-current or fixed does not have a high degree of liquidity. It has low or medium, as you can see. Same thing. All right. So I'll go back here. I want to talk about depreciation. I hope you heard the term before. And it's mainly about non-current assets. Okay, so we're not talking about something that has higher liquidity like cash. And it represents a store of service potential. Service potential is the key term here, that the organization intends to use, for whatever life of that asset. Okay, so assets have a limited life, right? You can't use them forever, and there's some kind of ongoing wear and tear. And after that, after a specific amount of wear and tear, like 2 years, 3 years, 5 years, whatever the asset is, then we cannot offer that level of service potential we're talking about. So then we need to stop using that asset and hopefully have the money to replace it. But usually when we stop using something, it doesn't mean that it doesn't have any more life in it. So let's say you have a motor vehicle, right, that we use to carry our coaches, a golf cart, like so that we use it to move our coaches around facilities. Okay, let's say we bought it for $10,000 brand new, right? And it can actually do the job we predict for 5 years. It can still work after 5 years, but it can not really do what it's supposed to do as efficiently after 5 year time. Cool. So we say, you know what, we're going to buy this. The coaches are going to use it to move around the venue, and we're going to sell it in 5 years. So let's say it costs $10,000, but when we sell it, it will cost $5,000 in 5 years. All right. So what we need to do is use that depreciation in those balance sheets. Okay. So based on all of these estimates as well, we can be like, okay, it costs us $10,000, and when we sell it in 5 years, we will get 5,000. So if we use, for example, the straight line or prime cost method in depreciation, that's how it's called, it's the simplest one, we add $1,000 as a value of depreciation for those 5 years. 5 times 1,000, 5,000, plus the 5,000 that we're going to get when we sell it in 5 years, that's 10,000. I hope it makes sense. So after those 5 years, it will still be running. We just won't use it because it has to do with the service potential, and we'll only use it for 5 years. We add $1,000 in our balance sheet for 5 years, and the 5,000 that we get at the end, then we will be able to buy a new one, assuming it costs $10,000 in 5 years. What else? Yeah, I think that's enough for depreciation. It's about something that we own that doesn't have high liquidity, but it will get devalued eventually. Okay. Yeah, okay. I think that's it. Now, I added here a case study about the Melbourne Cricket Club, MCC, and some of you have already had case studies about it. What I want to say here is that we're talking about something huge, like really huge facilities in Australia, in Melbourne, and MCCs on the Melbourne Cricket Ground on the MCG, very historic. Okay, that's the backstory. The thing is that in 2002, they decided that they had to demolish, and because it was aging, and then they had to put something back up that was state of the art. In order to do that, they borrowed a lot of money, more specifically 300 million Australian dollars, which is great. Okay, sure. but that's a lot of money plus interest. If we say that it is, 8%, so we're talking about at least 20-24 million in interest. So that's a lot of drain on the organization's cash deposits. However, because the MCC and the MCG have a lot of members, they have very strong membership fee source, income source. They have so many waiting to just get, in line. They have a 20-year waiting list to become a member for the MCC. They have so many people, right? It's really easy for them to generate income. Also, when they're doing some kind of top events, they can attract 50 to 80,000 people. So we're talking about a lot of money coming from tickets. What I was trying to make a case, and that's why I put it down here, is that yes, you can make a huge investment, and you can put yourself in a position that may look like you may be in danger. But if you have the background, and as I said, they have the members and they have the tickets to do it, then you're able to actually perform and get the new stadium and also pay it out soon enough, so you're not really in danger. Again, that you can invest in something expensive as long as you can have assets that they can offer those better quality services, and as I said, you have the support financially. All right, so what else did we leave here? We talk about asset valuation, intangible assets. I'm going to go to asset valuation a little bit. Is something that's not tangible, all right? And when we talk about tangible, here we're talking about, think about your favorite football team and the logo, right? The logo, as it is, it costs money. It worth a lot of money. It's worth a lot of money, and that's an intangible asset, which means your favorite team owns the logo and the value of the logo. Asset valuation. So a lot of times we own, let's say, assets, right? Let's say we own a building somewhere or a stadium as a company. Prices don't fluctuate that much or that often. However, it would be wise, especially we have land and buildings, to do some kind of reevaluation of those, so they're not undervalued when we have our balance sheet. So it's more accurate. Our balance sheet is more accurate. I hope it makes sense. All right, what's left? Liabilities. We talked about what we owe to other people. They can be categorized. We have current liabilities. We have non-current liabilities again. That's more long-term borrowings. Again, having a lot of liabilities, not necessarily something negative. As long as that liabilities, that debt can be used to build income earning assets, as in the example we just saw with MCC. So yes, increasing debt is not a good thing because it can be associated with losses rather than profits. So we have to keep an eye on it. And in a lot of the cases that you are presenting, you'll see a lot of teams that they didn't, and they ended up with a lot of financial issues. So ideally, assets would like them to be more than the liabilities. However, the liabilities can be more as long as at the end they generate, as we just said, they build those income earning assets. So then everything is just switched. Okay. So in our example, here, the liabilities were locked when they just borrowed all the money. But later, when we actually built the stadium, right, the stadia, which is plural for stadium, then these liabilities generated assets, which generated income. So we're good. And they have the way, as I said, with all the membership fees and all these events to generate money to function until we actually build them and then actually pay off interest. All right, 10.2, we covered it. Let's talk about profit and loss statements. So here we talk about the balance sheet, right? Which is at a specific point of time, knowing pretty much basically assets and liabilities. Here, what we do is we have a statement that talks about, it's not a snapshot, right? It's usually over a year. So it has different names, as you can see. This one, right? Income statement or financial statement of performance. It doesn't really matter how you're going to call it. All these are the profit and loss statement. Now, usually, as I said, it's over 12 months. It can be like trimester as well. And they accurately represent the total cash movements. And what I'm trying to say is that if you have an invoice of $1,000, right, it will be included even if at the end the invoice hasn't been paid. So it shows the movement of the cash, not the actual cash. Okay, I wanted to talk about that and make sure we understand that depreciation, as I said, is an expense. We talked about how we calculate it. We have to deal with it. We cannot just not face it, because at the end, if we have that vehicle I was talking about and we don't take depreciation into account, then we're going to have a problem, right? It has to do with, as I said, estimation of the wear and tear, and estimation of how much we're going to sell it if we sell it, and so on and so forth. But it has to be included. And then we have operating versus net profits. When we have these kind of statements, we need to separate the operating versus net profits. And operating is what we expect, okay, and it's normal. What has to be different here is the net profits, and that has to do with abnormal cases or irregular cases or extraordinary cases. So the abnormal case for net profits would be something it was kind of expected to happen, but let's say it's higher. Okay, and for the extraordinary is something that is a significant transaction that does not regularly occur. Okay, I just wanted to point that out. Here, let me give you an example and see how we can understand all these terms a little bit better. All right, so we have a profit and loss statement template, right? Here we have the operating income, how we made money for whatever amount of time. And that was 50 plus 10 plus 30, so 90. And this is how we spend our money. So which was 50 plus 20 plus 10, so 80. So if we put these two together, right, we made 10,000. That's our net profit, which is income minus expenses. 90 minus 80 equals 10. Down here, though, we don't have any non-operating income, so we're cool. But we'll have a special government grant, which goes down here, right? And that was $10,000. That's something that is of positive value, right? Then we also have depreciation, and depreciation is non-operating expenses. That was 20,000. So we, in the beginning, as I said, we had 10,000 plus 10,000, right, which is a grant. that was 20,000 minus the 20,000 from depreciation, we ended up with a net profit of 0. So no profit. Okay, that's how you read this template. Sorry. Operating activities, investing activities, financing activities. So here, what we're trying to explain is that when we talk about cash flow, that's really important because it's not represented in the other reports. And even if we know we have a profit or loss, we do not see exactly the flow of the cash. And so we have this report here to fill that gap. You see the kind of transactions that are included here. So the operating is a day-to-day transactions that happen. So we need these kind of activities to keep the organization running. Investing activities include, purchase and or sale of assets. And then the financing activities is, again, we're trying to borrow funds or we're trying to repay what we have already borrowed. That's what it is. Budgeting systems. Here you see the benefits of budgeting, okay? And what we need to understand is that whether you have a wealthy or non-wealthy organization, budgeting is important. What is budget? When you say the expression of that's our budget or my budget, what do you really mean? So there is a plan, right? You have some specific funds, and you have to figure out how to plan how to use them, right? Based also on your responsibilities. So it is a projection. And usually when we budget, we use the budget from last year or 2-3 years to budget next year. And we're just trying to be proactive. Okay. So that's what we're trying to do is like, if we actually plan it really well, we have the basis of efficient management, which, as I said in the very beginning, will ensure viability in the long run. And that's what we're trying to do as managers. So you see here all 6 benefits of having a budget. They're all great. I'm not going to read them. They're all self-explanatory, but we get the idea of why we should budget, why it's a projection. And we are trying to be proactive. There are many different kinds of budgets. I'm going to try to explain this one a little bit to see what kind of information you can take from this kind of budget. So here we have the cricket, right? A tennis club. We have a tennis club, and here you can see revenue, and it is by month. Cool. So you see here where we're getting revenue from, the sources of revenue, and then you see total per month. What do you see? If you see this column right here, who's the main player? Who is the player? Who is the main source of income? 6,000. Who's that? The sponsor. Wow. So that gives a lot of power to the sponsor. We have to be really careful. If we lose the sponsor, man, we have an issue. We have an issue. Okay. If you see it this way, what do you see? When do we have most of the revenue? If you said in March, you're right. Now the question is, so what? Well, if revenue is in March and then you have a significant drop, right? Maybe you should use a lot of money coming up and no revenue, right? And that's way to use an operating budget. Now, expenses. Let's see about expenses. When do we have most of the expenses? In March, but they're significant, like they're pretty much the same, a little bit, excuse me, less in December, which is great, right? If we see it this way, where do we lose most of our money? Where do we spend most of our money? 8,000, a lot of money in general administration services. So maybe we should look into that. Maybe we should look into that. Okay, we have to. Maybe we need to find a way to drop this. It's pretty stable, 2,000, right? But maybe we should do something about that. Keep this zero, continue zero. That's great. And a general kind of information is you compare this to this. So revenue 14 minus expenses 13 and a half. So the total is a net of 500. Okay, so you're in positive. You're in the positive side. That's one way to read this. Now we have uh, other kind of budget. The operating budget is, it showed as an example the anticipated levels of revenue for whatever period of time, and how we can use, or how will we use that revenue. So that's how we broke it down. Now here we have a program budget. That means that we still may have a budget of 14,000, but we break it down by program. Okay, so we give 4,000 the junior league, 8,000 the regional league, and 2,000 the veteran league. Whatever, for whatever reasons we do that, right? And then we have something that's called performance budget, and the performance budget, you see that shows the goal and the anticipated outcome of each program. So the good thing here is that it gives you direction, right? So whatever money you have, you need to use it wisely, but also trying to accomplish this increase in registered juniors. Here, all teams finish in top half of league table. Here, viable competition. So I just show you some different kind of budgets, so you have an idea, and you're not that kind of scared to take one in front of you, try to read it. Okay. All right, and that was it for today. Hopefully, it wasn't too much to digest. I'll read the take-home points as I usually do, and we'll be done for today and this week. Sound financial management is essential for the ongoing viability of sport organizations. As sport becomes more commercialized and corporatized, financial planning, record keeping, monitoring, and evaluation become even more important. Therefore, you, the sport manager, must be able to, one, identify the different ways to raise money, two, design detailed budgets, three, understand financial statements, and four, distinguish between the different ways of measuring surpluses and profits. That was it for today, guys. Thank you so much. I appreciate you. So again, if you are one of my advisees, please pick your time so we can finish advising hopefully this week, preferably, right? So my office hours will be limited tomorrow. If you want to log in, but I will be having advising at the same time. Not all slots are filled, and they're going to be that will be changing all the time. So if you want to log in, and I'll try to visit with you. That's all. That's all, guys. Have a great week. In the meantime, live intentionally, not habitually.